Hey there, real estate innovators. I'm Daniel Vosotas, and welcome back to my channel, where we dive into the future of hospitality, short-term rentals, and real estate innovation. If you're passionate about where this industry is headed, especially with tech like blockchain shaking things up, you're in the right place. I post weekly videos to help you understand these trends. So if you're new here, hit the subscribe button and turn on notifications. If you're a returning viewer, drop Daniel Vosotas in the comments so I know you're back. I always try to reply directly. Before we jump in, let me be clear. This video is for educational purposes only. I do not offer financial advice or investment services. Any reference to blockchain, tokenization, or DeFi are purely informational and tied to hospitality and real estate innovation. Today, we are exploring a hot topic, fractional real estate versus tokenized real estate. Is tokenization the future of property ownership, or is fractional ownership still king? These two models are changing how people access real estate, and while they may sound similar, they're built on very different foundations with unique benefits, risks, and flexibility. Let's break it down. First, let's talk about fractional real estate ownership, a game changer for short-term rental investors looking to diversify. This model has always been around, and it involves a group of people pooling their money to collectively own a property, typically through a legal structure like an LLC or a syndicate. Each investor gets a share of the rental income, and if the property is sold, a portion of the profits from appreciation. The heavy lifting, think management, maintenance, and tenant relations, is usually handled by a platform or third-party manager. So in theory, you buy a piece and the platform takes care of the rest. The advantages are clear. Fractional ownership lowers the barrier to entry. Instead of needing hundreds of thousands of dollars, you can get into real estate with just $5,000 or $10,000. It also allows diversification, letting you spread smaller investments across multiple markets or property types. Plus, there's predictability. Rental income, often paid quarterly, and professionally managed properties. But there is a catch. Liquidity is a big limitation. If you need to sell your share, you might have to wait for a resale window or rely on the platform to find a buyer, which could take weeks or even months. And then there are the fees, management, legal, performance, and platform charges that can eat into your returns over time. Now let's shift to tokenized real estate, which is where blockchain technology comes in. Picture this. A property in Dubai or a short-term rental in Miami is converted into digital tokens using blockchain. Each token represents a fractional ownership share recorded on a secure digital ledger. Instead of holding shares in an LLC, you hold tokens in a digital wallet. These tokens can often be bought, sold on secondary markets, sometimes instantly, depending on the platform and market conditions. They can carry rights to income, access, or even governance, depending on how they're programmed. Smart contracts automate distributions, ensure compliance, and provide transparent reporting. Some platforms even let you use these tokens in decentralized finance or DeFi to generate extra yield through lending, staking, or liquidity pools. The benefits of tokenizations are exciting. Liquidity is a huge win. You can trade tokens on secondary markets without waiting for quarterly windows or dealing with paperwork. The entry point is often lower, with some platforms allowing investments as small as $100. And because it's blockchain based, tokenization opens real estate to a global market, accessible to anyone with an internet connection and a digital wallet. But there are risks. Regulation is still catching up, and the legal framework for tokenized assets varies by country, creating uncertainty. There's also platform risk. If the company managing the token shut down or gets hacked, you could lose access to your assets. And unlike traditional real estate, token prices can be volatile, moving with crypto market trends or investor sentiment, not just property performance. To make this clearer, let's look at two real world scenarios. Imagine you invest $10,000 in a fractional ownership platform, getting a stake in multiple commercial properties. These properties generate a steady 6% net annual yield, paid out quarterly, and everything's professionally managed. It's stable, it's predictable, and passive. When you need cash unexpectedly, you can't sell your position quickly. You're stuck waiting months for a resale window and a buyer match. Now picture a different scenario. You buy $5,000 worth of real estate tokens tied to a short-term rental property. These tokens also generate a 6% rental yield, but you stake them in a DeFi platform, earning an additional 6 to 7%. When you decide to sell, you liquidate the tokens in minutes on the secondary exchange. The trade-off, higher volatility, the need to monitor markets closely, and trust in the security of those DeFi protocols. So what's the difference? Fractional ownership is structured, passive, and less liquid, perfect for long-term hands-off investors. Tokenization is dynamic, potentially more profitable, and offers global access, but it demands more knowledge, engagement, and risk tolerance. The choice depends on who you are as an investor or operator. If you want steady income with low complexity, fractional ownership is familiar, widely accepted, and backed by clear legal structures. If you're comfortable with blockchain and digital wallets and want higher liquidity or integration with financial tools, tokenization is a game changer. There's also a hybrid model emerging, blending tokenized shares with traditional legal structures for the best of both worlds, regulatory clarity and blockchain efficiency. Looking ahead, tokenization is likely to grow, especially in short-term rentals where operators already use tech platforms, dynamic pricing, and global reach. As technology improves and regulations clarify, more real estate syndicates, funds, and hospitality companies will likely adopt tokenized structures. For those of us in hospitality and real estate, the takeaway is simple. Understand both models. You don't need to be a blockchain expert or a finance guru to see the shift happening. These aren't just ideas. They're being used today to fund, own, and manage properties worldwide. I'd love to hear your thoughts. Are your team fractional ownership or team tokenized real estate? Drop Daniel Vosotas in the comments and let me know. I'll reply directly. If this video helped clarify the difference between these models, give it a like, subscribe, and turn on notifications. I'll post every week on hospitality trends, real estate innovation, and how technologies like blockchain and DeFi are reshaping the landscape. Thanks for watching. I'm Daniel Vosotas, and I will see you in the next one.